Welcome to Iron Financial. Listen, today we are stepping straight into the forge to examine a truly fascinating corporate metamorphosis. We're looking at Wiley, ticker symbol WYLY. Now, for over 200 years, Wiley has been a traditional legacy publishing house. Textbooks, academic journals, physical print. But over the last 12 months, they've been throwing that entire legacy business model right onto the anvil and hammering it into something completely new. We're talking about a modern, high-margin, AI-driven data powerhouse. And let me be clear, this isn't just a slight cosmetic pivot. This is heavy-duty structural transformation.
Right, and as always, we aren't just going to sit here and take the executive summary at face value. That's not what we do. We represent you. We are here to hunt for the cracks in the armor. We need to find out if this transformation is actually structurally sound or, if it's just smoke and mirrors designed to distract investors from a dying print business.
Now, you might be wondering, why does this specific legacy-to-tech pivot matter to you, the investor, right now? Well, it's because Wall Street algorithms and surface-level screeners absolutely hate construction noise. The market routinely misprices these massive structural shifts. They mistake the temporary financial friction of a turnaround for fundamental, permanent weakness. Here at Iron Financial, our entire mission is to help you forge a stronger portfolio. We want to help you cut right through that market noise to find the durable steel underneath.
Exactly. If you want uncompromising, deep-dive financial analysis that actually tests the structural integrity of the market's biggest movers, hit that subscribe button right now. We are going to meticulously break down the WLY fiscal 2026 fourth quarter and full year results, and we absolutely refuse to gloss over the data.
Let's look at the raw material we are throwing into the forge today. Wiley's president and CDO, Matthew Kissner, came out swinging in this report. He stated, and I quote, "Fiscal 2026 was Wiley's breakout year. We accelerated our two reinforcing growth engines, research and AI and data analytics, while delivering record margins." I mean, that is a bold, definitive thesis to hand to your shareholders.
Yeah, the executive team clearly believes they've forged a new foundational strength. But look, I'm the market skeptic, and I'm simply not buying it until we subject this earnings report to intense structural pressure. Anybody can say breakout year. Let's see if those margins actually hold up when we apply the heat.
All right, here is the Iron Financial blueprint for today's explainer. First, we'll cover the legacy-to-tech pivot. Second, GAAP reality versus adjusted strength. Third, margins and the learning drag. Market skeptic. Fourth, the dual engines of research and AI. Fifth, the cash flow fortress. And finally, we'll wrap up with the FY27 outlook and our definitive final verdict. No fluff, we are drilling down into the spreadsheets right now. Section 1, the legacy-to-tech pivot, forging the future. You really have to understand the immense, grueling friction required to modernize a company with a 2-century-old footprint. It's like turning an aircraft carrier. Wiley is doing the heavy lifting right now. They are officially a predominantly digital company today, with over 83% of their adjusted revenue generated strictly by digital products and services.
Market skeptic. But let's be real, reaching that 83% threshold is incredibly painful. It means aggressively sunsetting legacy products, it means divesting massive physical warehouses, renegotiating ancient supply chains, and somehow standardizing digital rights management across thousands of fragmented academic portals. It's a logistical nightmare.
You're absolutely right. It requires eating massive restructuring costs up front. But think about the other side of that. When you finally shed the physical constraints of printing, storing, and shipping heavy textbooks, you fundamentally change the operating leverage of the entire corporation. That digital base, that 83%, that is the new anvil we are working on. Which brings us to GAAP reality versus adjusted strength, the heat. This is where we turn up the temperature and pit the top-line revenue numbers directly against the bottom-line execution. I am looking at the hard numbers here, and the divergence is just wild. GAAP revenue is sitting at $1,677 million. That is dead flat year over year, literally stagnant top line. But then you look at operating income, and it's skyrocketed to $277 million, up from $221 million the prior year. Let that sink in. That is a massive 25% surge in raw operating income on flat revenue. If you are a trader screening for pure top-line growth, you completely miss this stock. You walk right past it. But if you screen for structural efficiency, warning bells should be ringing loudly.
Whoa, hold on a second. How exactly do you squeeze 25% more operating income out of a completely stagnant top line without using some kind of smoke and mirrors? That sounds exactly like an accounting illusion to me.
It's a fair question, but it's not an illusion. It's the result of strategic divestitures. You see, that flat revenue includes the heavy drag of selling off non-core businesses. segments like Wiley Edge and Cross Knowledge. They actively stripped out the weak low-margin alloys. When you adjust for constant currency and look strictly at the retained portfolio, the core business they actually kept and care about, adjusted operating income is actually up a staggering 18%. So this isn't a top-line growth story right now. It is a profound structural profitability story.
And frankly, nothing hammers that structural leverage home quite like this number right here, $4.16. That is the GAAP diluted earnings per share for the fiscal year, absolutely crushing the $1.53 they posted the prior year. I mean, going from $1.53 to $4.16, this explosion in EPS proves that the underlying machinery is generating significantly more value per individual share. They drove this through a combination of higher cash earnings and a highly disciplined reduction in shares outstanding. Retiring shares when your retained business is becoming vastly more profitable acts as a massive financial multiplier. They are doing significantly more with less.
Okay, let's move to margins and the learning drag the hammer. Let's shift the debate to operational efficiency, because a strong bottom line is only as durable as the margins that actually support it. Let's see if the foundation has cracks.
Well, the margin expansion WLY is achieving is nothing short of incredible. Adjusted EBITDA margin is stepping up so aggressively, 22.8% in fiscal 24, 24.0% in fiscal 25, and now a record 26.2% for fiscal 26. That is a jump of 220 basis points overall. And listen to this. If we isolate just the fourth quarter, the adjusted EBITDA margin hit an eye-watering 33.2%. In a macro environment where literally everyone is fighting inflation and rising labor costs, expanding margins this rapidly shows immense pricing power and ruthless operational discipline. Yeah, I have to interrupt here because I'm seeing a red flag. To achieve these record margins, WLY slashed corporate expenses by 21 to 22% in the fourth quarter alone. My cynical question is this: is this actually sustainable efficiency, or are they just cutting straight into the bone? Are they stripping out so much structural support, technology, HR, finance, that the building is eventually going to collapse from deferred maintenance?
Management claims this is strictly driven by a multi-year technology transformation and a massive managed services partnership with Retusa. By outsourcing IT and managed services, they are permanently lowering fixed costs and turning them into variable costs.
Maybe, but as investors, we have to watch closely to ensure these aggressive outsource cuts don't compromise the quality of their future product development. You can't cut your way to long-term growth. And that brings us to the learning segment, and let me tell you, it is a major structural crack in this armor. Academic revenue is down 4%, professional revenue is down a painful 9%. This is heavily impacted by soft retail channels, Amazon inventory management adjustments, and just the relentless secular decline of the physical print textbook. This segment is bleeding out, and it is the legacy weight holding the entire WLY portfolio back. Look, they are actively managing this decline by shifting to digital products and inclusive access models. But you are absolutely right. There's no denying that the learning segment is a heavy structural drag right now. It's the rust they're still trying to grind off. So let's talk about the dual engines, research and AI, powering the shift. If the learning segment is the primary drag, what exactly is doing the heavy lifting to offset it? The answer is the high-margin, futuristic AI kicker. WLY delivered $49 million in AI revenue this year, representing a 23% increase, and their lifetime AI revenue has now crossed $110 million. They are carving out a massive early lead in life sciences and healthcare AI. Take the landmark partnership with IQVIA, for example. They are taking clinical outcome assessments, which, by the way, are federally mandated, scientifically validated instruments used in pharmaceutical trials, and they're moving them from basic copyright licensing to comprehensive multi-language electronic trial-ready solutions.
And we have to point out, because those electronic assessments are embedded directly into clinical trial protocols, you can't just rip them out. That creates a very sticky, high-margin moat. Once they're in, they're in.
I will fiercely defend this portfolio's shifting weight. The research segment is the massive foundational pillar supporting this entire transition. It generated $1.13 billion in full-year revenue, growing at 4% on a constant currency basis. WLI saw a 26% increase in submissions and an 11% increase in output, driving massive double-digit growth in their gold open access models. The academic and scientific world simply cannot function without access to this peer-reviewed research. It is an absolute necessity, making this revenue highly durable. Okay, but I am cynically challenging this AI narrative right now. When a big tech company pays Wiley $20 million for an AI licensing project, is that actually a durable, recurring software model, or is it just a one-off data scraping windfall? Are the large language model builders going to train their algorithms once on your textbooks and journals and then never need Wiley again?
Management is heavily countering that exact fear by building out the Wiley Nexus Partner Network and launching an AI gateway platform focused on recurring inference pilots. They are making the very strong case that AI requires constant, continuous access to the newest peer-reviewed research to prevent hallucinations. You can't just train it once. It is a continuous stream, not a one-time data dump.
Now, let's look at the cash flow fortress, the Quench. When you really want to test the foundational strength of any turnaround, you don't look at adjusted earnings. You look at the cold, hard cash flow statement. And this metric is spectacular. $261 million in operating cash flow. That is a 29% increase over the prior year. Listen, operating cash flow is significantly harder to manipulate through accounting loopholes than adjusted EBITDA. If you are a seasoned trader dissecting the balance sheet, this is the exact proof you need. The cash from working capital improvements and higher structural margins is actually hitting the bank account. They are generating raw, tangible financial power. Cash pays the bills, not adjusted accounting metrics. Which brings us to $195 million in free cash flow, a massive 55% surge year over year. That is huge.
It is huge, but we must issue a serious caution here. This massive free cash flow surge was heavily aided by artificially lower capital expenditure. CapEx dropped to just $65 million in fiscal 26. Looking ahead, CapEx is slated to rise to $80 million in fiscal 2027, as they're basically forced to invest back into their technology infrastructure. So while $195 million is a fortress-like number today, you have to price in that higher reinvestment cost and tech debt repayment going forward. It won't be this easy next year.
True, but even with that rising CapEx, the capital allocation strategy here is incredibly aggressive. WLY just raised its dividend for the 32nd consecutive year. On top of that, they executed a massive $100 million share buyback this year. They returned a record $174 million to shareholders in total, shrinking the share count by over 1.9 million shares year to date while simultaneously raising the dividend. That shows supreme, uncompromising confidence in the durability of their core cash generation. All right, FY27 outlook and final verdict, the final blade. We've pressure tested the past. Now we have to inspect the future guidance to see exactly where this machine is heading. The fiscal 27 guidance proves that the mix shift is doing the heavy lifting. Despite the ongoing drag from the learning segment, they actually expect low to mid-single-digit organic revenue growth driven almost entirely by the research segment. But the bottom line is the real story here. They project adjusted EBITDA margins to expand even further, reaching between 26.5% and 27.5%. And they are targeting adjusted EPS rising to a highly profitable range of $4.60 to $5.05. They are keeping the hammer down on efficiency. Now we also have to factor in the new Emerald Publishing acquisition. It brings in $78 million of expected revenue and adds 10 cents to EPS, rapidly increasing WLI's proprietary content advantage for the new AI economy. It's a strategic grab.
Sure, but look at the other side of the ledger. Digesting Emerald creates a heavy $15 million drag on free cash flow in fiscal 27. Integrating back-end systems, handling severance, and combining sales forces is expensive and messy. Does this acquisition reinforce the foundation by cornering more AI data, or does it add unnecessary weight and massive integration risk just as the company was finally getting lean?
So, what is the final iron financial verdict? Is WLY a reforged value play with a high-margin AI kicker? Or is it a declining legacy textbook business masked by temporary AI licensing juice? Our definitive stance is this. WLY is a reforged value play. The sheer cash flow generation, the 32-year dividend history, and the relentless structural margin expansion prove they have successfully stripped away the weakest parts of their legacy business.
Market Skeptic. I'll admit, the WLY armor holds. The research and AI engines are generating enough high-carbon strength to carry the portfolio. But we leave you with this provocative thought. If AI models eventually stop needing fresh textbook data to learn, does the Wiley AI engine run out of fuel? Or have they truly built an irreplaceable recurring gateway? Stay disciplined, keep pressure testing the numbers, and we'll see you on the next explainer.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.